All right, good morning, everybody. This is Brian Lysing with Financial Brokerage, and we are starting IUL Basics this morning. For those of you that are not familiar with financial brokerage, we are a national marketing organization working with primarily independent producers around the country with fixed life insurance, annuities, long-term care, critical illness, disability insurance, and Medicare supplements. I've been with the company for about 17, maybe 18 years now or so, and I'm the life insurance sales director, one of them, working obviously primarily with life insurance products. And I love talking about IUL. It's one of those topics that's maybe a little more optimistic. We're not always talking about death and the death benefit, but more about the cash accumulation and what a person can do with the money inside their life insurance contract while they're still living. Obviously a much happier conversation. But IUL Basics, this came about because of our sales challenge here in the month of May. If you saw the email yesterday, you'll know that we are offering bonus success shares, actually double shares, for all IUL business submitted in the month of May. Those shares can be used to help you qualify for our incentive trips. And this year we have one you can qualify for, a real affordable one. It's a New England cruise. We're going to make some stops in Canada as well as in the U.S. And then the big trip is going to be out to Hawaii, much warmer location. And if you're trying to qualify for these double shares for IUL business in the month of May will really help. There's a couple other caveats, including posting on the blog that went with that email. But this is all part of that life insurance sales challenge. We're going to host some webinars like this one here to make sure you know how Index Universal Life works. And then every Thursday, you want to check your inbox for some sales pieces from some of our top insurance carriers here at Financial Brokerage, giving you more information on how to apply this knowledge and some more specific sales ideas. What I want to do this morning is give everyone a background on Index Universal Life. And I would say this is really a two-part webinar. To start with, we're going to go through the history of Index Universal Life. How did we get to where we are today? And then the second part will cover the inner workings of IUL, the index strategies and the index crediting methods. And we'll get to a little bit of applications at the conclusion, but this webinar is really meant to focus more on the history and the inner workings of the IUL so that you know what you're talking about when you then go out and apply this to your clients and prospects. All right, so how did we get to where we are today? Well, Index Universal Life is the latest in a long progression of life insurance products that have hit the marketplace over the last 100, 150 years or so. Whole life is probably the original life insurance coverage that was out there. It's been around the longest. Offers your clients some cash value, and it's meant to have a lifetime of coverage for those folks. Term life came about later on, and we know this is pretty much no-frills, temporary coverage. It's going to go away at some point in time. I like to look at universal life as just whole life policy that has been disassembled into its various pieces to give the client some control. Variable universal life takes that UL chassis and adds in a stock market component. The client could lose money with those. And the IUL, as you'll see here in just a second, was sort of the next step in the evolution of those products. And with every one of these, what we found throughout history is that the industry comes up with something, they sell it to people, and some clients say, well, I like this feature, but I would really like to do this. And then they sell that, and then people say, well, yeah, we like this, but we'd really like the policy to also do this. We'd like to change something about it. So it's a natural evolution of the product. And we'll go through here briefly to get you up to speed on where we are today with these. So we're going to go back to 1979 and what was going on in the world financially back in 1979. Well, CDs and banks were yielding 12% interest or more. And in part because of that, the whole life policies that people had purchased for cash accumulation purposes maybe, in addition to the death benefit, began to fall out of favor. The whole life products just could not compete with the interest rates that folks were receiving at their local bank. So money flowed into the banks. Well, now the Insurance companies have a problem. They're not getting the premiums they used to. What can they do to compete? Well, there was this idea that folks came up with. They called it buy term and invest the difference. That became very popular. Now, instead of putting your money into whole life where you're not going to earn as much interest as you could elsewhere, you can buy term insurance for a very low price and invest the rest of your money in the market, or maybe into those bank CDs if you wanted a fixed rate of return for a certain period of time. That's what was going on back then. And in part because of that, in 1986, the industry introduced variable universal life. And now consumers had access to life insurance that really did that whole buy term and invest the difference within one contract. They didn't have to get two separate products out there. They could do it all in one, all inside their life insurance contract. So that was the next best thing in 1986. And fast forward about 10 years now, we saw the introduction of fixed index annuities. Now, we know around 1995 the stock market was still going like gangbusters, but there were some people out there who said, well, you know what, I like the increase that I'm getting on my money in the market, but you know what, when that goes down, I'm going to see some, or could potentially see some pretty significant losses. So how can we keep those losses from happening and just move forward? Well, that's how we got index products on the annuity side. You know, a client can put money into a policy, and it only goes one direction, only goes up. You're not going to get the entire growth, let's say, of the stock market, but you're going to get a good chunk of it. Now, index annuities went over so well that in 1997, we saw the first index universal life contract introduced in the marketplace. And as I mentioned with the annuities, you know, clients now had access to index-linked crediting strategies that gave them this upside potential without any of the downside risk that they saw sometimes on their variable universal life contracts. Now, index life went over so well that, you know, we can see here it was introduced in 1997. Just 9 years later, we saw that $350 million went into IULs in the marketplace. 6 years after that, 2012, we saw $1.4 billion go into IUL. And I should probably update this because I saw the numbers from LIMRA for last year, for 2015. I don't remember what they are off the top of my head, but I know that IUL sales continue to increase each and every year. So, I mean, $1.4 billion, if you're not selling IUL and talking about it to your clients, obviously a lot of other people are, and you need to make sure that you're getting your share of those premium dollars. So now we know the history and how we got to where we are with IUL. Well, how do these products work? Well, one of the best ways I've found to explain IUL is to compare it to a traditional fixed interest rate UL. And I love this analogy. When you think about a fixed interest UL, and if you run the illustration, you see that a carrier might be guaranteeing your client 3% interest, let's say. But they could change that, you know, and they guarantee 3. Maybe this year they're paying 4, and maybe next year they pay 3.75. Then they pay 4.25. You know, the current interest rate can change. Well, how do they determine that current interest rate? I mean, do you ever think about that? We just take it for granted. How does a bank determine a CD rate or a savings account rate? You know, it's ultimately up to the entity that's selling the product to come up with that interest rate. And I mean, they might tell you it's based on, you know, the market and the fixed interest investments we put the money into and all that. But I mean, how do you really know? Do they share all the data that their actuaries compile to come up with whatever rate they can offer to their consumers? And you know, they're still making money on that too. So this is an interesting picture, and I like to think that you've got the board of directors of the company, and they're sitting around, they're looking at the figures, and then they're figuring out, okay, well, here's what our actuaries tell us we can give the clients. How much do we want to make off the top of that for our salaries, and we'll give the people the rest. I mean, does it really happen that way? Who knows? But you know, bottom line is, you know, these interest rates may as well be determined in the smoky boardroom, and you have no idea. There's no transparency as to how they determine that. Now, an index universal life is completely different. Everything is very transparent as far as how they determine the interest that your client will end up receiving. On an index product, you usually have a formula that's in the client's contract. And that formula, first of all, it's written down. It's published information. And the formula is based upon other information that's public and published. Usually it references the stock market. The S&P 500 is most commonly used. You can find the numbers for the S&P 500 in a million different places. It's in every newspaper in the country. It's online on everybody's website, CNN, Yahoo Finance, you name it, it's out there. You can find this information, all the historical data. It's public and published information based upon a formula that is contractually guaranteed in the client's policy. So it's not determined in the smoky boardroom. It's very transparent how the interest is determined on the IUL products. Now, some people ask me from time to time, well, is this a securities product? Do we need to have a securities license to 63, Series 7? Do we need to be an investment advisor rep to sell this? And no, you absolutely don't. This is still a general account product. It is not a security product, and reason being, the client cannot lose money due to market performance. Their money is never actually in the market, and we'll go over how that works at the carrier's level. But this is still a fixed product as far as all the regulatory agencies are concerned. Now, if you've sold universal life of any kind in the past, you've seen this diagram, and index universal life works the same way. This is the typical bucket diagram, and just in general, you can think of the client's premiums going into the policy, and it goes into the cash value, which should accumulate over time. Money's going to come out on a regular basis to pay the cost of insurance, to pay any premiums for riders, the admin and expense charges, and interest is going to be credited on that money that's already in there, in addition to the premiums that the client is pouring in on a regular basis. The client also has an option to take money out of that bucket, which is why a person would want to use these primarily through withdrawals or through loans, and we'll get into those later on. But how do we determine those credits? Remember, I mentioned that it's public and published information. Well, there are two moving parts that we see on all of these formulas. And let's see if I can find that. I'm going to get to that in a second. All right, I'm jumping ahead. I had mentioned earlier the S&P 500 is the most commonly used index that they apply this formula to. Some insurance companies will use other indices out there, the Dow Jones, the NASDAQ. Some will use a combination with the S&P, with the Euro stocks, and the Hang Seng index. All right, here are the moving parts that I was alluding to. There are two of them that you'll find with these formulas. One is the participation rate. I'll give you an example of how that works, probably the best way to explain it. Let's say the formula says that we're going to base the client's returns on the performance of the S&P 500. Well, most commonly you're going to see that with an index, your client's going to participate 100% in the market. Whatever that return is, they're going to get that entire return. Now, that might be a cap applied to that, but usually they're going to see the whole performance. So if the market goes up 10%, they're going to be credited with that 10%. Now, there are some index crediting options out there where an insurance company might say, you know what, we're going to give you 60% of whatever the S&P 500 does. It's available. It's not very common on the life insurance products. Usually you're going to see a 100% participation rate. Now, the other moving part, the cap rate, that's what is going to differ from company to company primarily. So say they have a 100% participation rate, it's usually going to be capped at a certain number. And I've seen anywhere from 8.5% to about 14% on that. So what does that mean? Well, if the S&P goes up 7% in one given year, and you have 100% participation, guess what? Your client's going to get credited with 7%. Now, what if the S&P went up 20% in a given year? Well, if you had a cap rate of 12, you're not going to get the 20, you're going to get the 12 because that was your cap. Now, the S&P has not gone up 20% too many times, so I think most folks are going to be pretty happy if they had a 12% cap and a 12% return. You'd be happy with a securities product that gave you 12% return, I think. Now, what's the company doing behind the scenes to be able to offer this to your clients? Well, I like to envision this, and I wish I had the graphic in here, but I like to picture a dollar bill and have that dollar bill cut up into different portions. So the largest portion of your client's dollar that's going into this policy, the company is using that, and they're putting that into their fixed income investments, into their general account, the bond funds and safe money strategies that they use for all of their fixed interest products out there. That's by far and away the bulk of that dollar. A small part of that dollar is going to go to the expenses and the cost of insurance for that product. But, that's the same on any life insurance product out there, whether it's term or whole life or you name it. Now, with an index product, they typically guarantee a much smaller guaranteed interest rate than what you'd find on a non-index UL. So if the regular UL is going to guarantee you 3%, your IUL might only have a guaranteed interest rate of 1%. It doesn't take them nearly as much money to be able to maintain that 1% guarantee as it would the 3%. So what do they do with the extra part of that dollar that's left over? Well, the company is going to take that extra part of that dollar and go out and buy options, usually on the S&P 500. And let's say the option has a 12% cap. So they're buying the option, and they have a fixed cost. They're paying somebody that money, and that money is gone no matter what happens. So two things will happen. If the market doesn't perform, if the market actually is negative, then that option is going to expire worthless. But the client isn't out any money, and the company had already accounted for that cost, right? Because they're guaranteeing the client a pretty low interest rate on the guaranteed side of things. So they're not concerned about that. Now, if the market does perform well, then they're going to be able to exercise that option, and they're going to be able to see the gain from that, and then have the money to turn around and credit to your clients. So if you've been securities licensed and are familiar with options, this is all very familiar to you. If you're new to IUL, this is what's going on behind the scenes at the carrier investment level. Again, the client's money isn't directly involved in the market at all. The insurance company is taking part of their own money and buying options usually on the S&P 500. Here's an example of how that might work too. Let's say the company is earning 6% on their assets, and they only need 0.5% of that to guarantee the guaranteed interest on the product. Now the company has the other 5.5% available as their option budget to go out and buy options and see if they can do a little bit better. Same thing if it was 5.5% that they were earning on their general assets. All right, for the second to last part, I want to go over the index crediting methods that you typically see on these products, and there are 4 of them. There may be more out there. I know one of our insurance carriers here has a good dozen or more, but I'll tell you that about 95% of all IUL products sold use the annual point-to-point crediting method, and I'll go over that one first here. So the way an annual point-to-point works, I think it's best explained through an example. And these are actual numbers too from the S&P 500. At the end of September in 2013, the S&P was at 1,681. a year later, a trading year later. That's why the dates are different. It was up at 1977. So what does that mean? That's a 17.62% increase, and that's what would be credited to your client's policy, subject to whatever cap happened to be on there. If there was a 10% cap, they'd get 10. If they had a 14% cap, they'd get 14. If they had a 20% cap, they'd get the 17.62. I don't know of any products that have caps that high, but that's how the annual point-to-point would work. Pretty easy to figure out. All you have to do is look at the S&P 500 on a given day, the day your money went into the contract. Look and see where it is a year later. Apply the cap to it, and there you go. That's the interest that your policy is going to be credited. So it's pretty simple. That's probably why it's used most often. Now, some companies will offer your clients a monthly point-to-point, and here's an example for you. They're going to look at the S&P 500, the gains and or losses each and every month. So, give you an example here, January. If S&P had a gain of 5%, but you had a cap of 3, you're going to get credited with 3. Same thing in March. If it went up 2, your cap is 3, well, you're going to get credited with 2. Now, April gets a little interesting. S&P was a negative 2%. Cap doesn't matter because you went negative. You're going to get credited with negative 2. This is where you should say, wait a minute, you can't lose money with an index. How does that work? Well, with a monthly point-to-point, what the insurance company is going to do is add up all those numbers in that credited interest column. They're going to add the positives and the negatives together, and whatever that number ends up being is going to be what's credited to your client's policy for the year. Now, if it happens to be a negative number, they're going to get 0 because they will not credit a negative interest rate to your client's account, right? So that's where that floor comes into play. But each and every month, for purposes of the computing that number, you're going to see positive numbers and potentially negative numbers. But this can help you take advantage of some big gains in any one given month and try to even out some of the losses in months along the way as well. So we don't see monthly point-to-point too often, but it is an option with some of the insurance companies. Monthly averaging. This is another option you might see too. And this tends to have returns that don't fluctuate quite so much, right? Whenever you average something out, you're getting something that's kind of in the middle. It's going to even out the highs and the lows. The really good months aren't going to help you as much, and the really bad months aren't going to hurt you as much either. But in this example, what the insurance company would do is look at the S&P 500 on your policy date each and every month, add those together, divide by 12, and give you that average, in this case 1,074. They would then compare that average number to where that average number was a year prior. Whatever the gain is what you get, subject to the cap. So that's monthly averaging. Again, you're not going to see a whole lot of fluctuation from year to year there. Now, the fourth option insurance company might use, and we do have this with 3, maybe 4 the carriers here at Financial Brokerage. They will use what I would refer to as a multi-index weighted point-to-point. Be careful who you use this with and speak to about this, because their eyes may glaze over as soon as you say that right there. But if you have some folks that are savvy investors, they're used to working with index products, or they're used to having investments in various entities from around the world, this might be something for them. So typically what we'll see in this case is that a company will use 3 different indices, 1 from the U.S. and 2 from other parts of the world. And they're going to assign weights to the returns in each one of those. And usually you'll see that 50% of the return is going to be based upon the best performing index of those 3, 30% of the second best, and 20% of the third. Or what you also might see is maybe 75% weighted to the best one, and 25% to the second best, and nothing to the third. Now, we don't know in any given year which of these indices is going to perform the best. This is a great way for your client to make sure they're going to have the best performing index each and every year and have more of their money tied to that rather than the one that performs the worst. So those are the inner workings of the IUL contracts. Probably a lot more there than what you would ever want to explain to a client. But I'm going to get into briefly here, why are we using life insurance and what are some of the potential applications? Why are we putting money into a life insurance contract? Well, to explain that, you really have to know the four sources of money that are out there, and we're talking about retirement money in particular here. So one way a person could get money for retirement and accumulate it would be if the money was free. They inherited the money, right? That doesn't cost you anything. 401k matching funds. Hey, that's free. It's an extra bonus from your employer. The next best type of money would be tax-free money. This is money that you've earned. You've paid taxes on it initially, but all the growth that generates is going to come to you tax-free. And that would include Roth IRAs. Life insurance comes into play here, municipal bonds, and there should be an asterisk after municipal bonds because even though they're not taxable at the federal level, the interest is counted towards your income when they determine whether your Social Security income is taxable or not. So in a roundabout way, that could come into play, and you could end up paying some taxes on that. Most folks aren't aware of that. The third best type of money would be tax-deferred, money in annuities, 401ks, IRAs. You're getting a break on it now, but you know what? You still have to pay taxes, or your heirs will if you don't. So the government's going to get that money. Then the fourth type of money we could be talking about would be taxable money. You're paying taxes on that each and every year. So life insurance is in one of the best categories, and probably the best category that an individual has complete control over, right? You don't control when you get an inheritance, or if you do, and in some cases you don't control the matching funds on a 401k. Now, what makes life insurance tax-free? Well, it goes back to the tax code, and as long as you don't have a modified endowment contract, the money coming out of that policy, including the growth, comes back to you tax-free. Withdrawals would be tax-free. Loans come to you tax-free as well. And there are a couple tests that go on within the illustration software to help determine that. You can either use the guideline premium test that's used primarily, and that restricts the amount of paid premium relative to the death benefit. So if you have a guideline premium violation, you won't enjoy these tax benefits, and you'll have what's called a modified endowment contract. There are some ways to keep from having that violation happen. The other test that an insurance company may have available is the cash value accumulation test, and that restricts the cash value relative to the death benefit. I mentioned earlier we usually use the guideline premium test on the illustrations. That works best if we're paying the maximum premium possible into that policy for 10 years or more. We want the most cash value possible. We want a death benefit still available at age 100. And you can also, usually in these illustrations, we will switch from an increasing death benefit option to a level benefit once we start taking distributions from the policy. Now, when might you use the cash value accumulation test in an illustration? This will work well in some short pay scenarios when we have large dump-ins, whether it's just a lump sum dump-in or maybe a 1035 exchange from another policy. And on the products that are designed as modified endowment contracts for wealth transfer, they're usually using this cash value accumulation test. Now, how do we get the money out of these contracts? Well, one way to do it would be to withdraw to basis, right? You can take your growth out of a life insurance policy as long as policy still remains in force. You can take all that growth out, and that comes to the client tax-free. The other thing you can do is take a loan from the policy, and companies usually offer two different types of loans on Index Universal Life. One is the traditional fixed loan, where you know what the interest is on the loaned money. You don't necessarily have to pay it back, but going to be a set rate. And usually these become wash loans, where the amount that you're credited is equal to the amount you're charged. Usually that happens after year 10. Now, a lot of companies offer what they'll refer to as a variable loan, a collateral loan, or a participating loan. They all tend to have different names for it. But with these, the money that has been, the part of your money that has been loaned out to you will keep earning interest based on that index. And the amount that they charge you for the loan will be based on a different formula altogether. Usually it's based on a bond index. So you might be receiving 12% on your money through the index. They're charging you 5% through the bond index. You're still having a net gain on money that's been loaned out to you. Now, the opposite could happen, though, too. They could charge you 6% based on that loan index. You know, if the S&P isn't doing anything that year, then you're being charged that 6% against the account value, and you haven't gained anything in that particular year. Another quick little idea. I know I mentioned I wasn't going to get into sales ideas, but here's a quick one too regarding college planning. We've been talking about retirement planning with this. You can also use IUL to help plan for college and provide some money. Again, loans are received tax-free. You can use the money for anything out there, as opposed to, say, a Section 529 college savings plan, which has to be used for a family member for college education. If the child ends up with a full ride scholarship, they don't go to college, maybe they go to the military or what have you, you know what, you're not restricted on the use of those funds. You can tap into those at any time, and the best reason to use life insurance for college planning, the money in those contracts is excluded from the FAFSA calculations. It will not count against the family's expected contributions to help pay for college. So there's a quick idea for you. I'm going to go into that a lot more in depth next week when I host a college planning webinar. So that's the IUL Basics. I'd like to thank everybody for joining us, and don't forget to sign up for our Life Insurance Sales Challenge here in the month of May. The email went out yesterday, has the link to the blog. All you have to do is opt in. Say, I want to do this. I want to sell IUL. I want the double success shares throughout the month of May for all of my IUL business. And we'll keep sending you all sorts of sales ideas every Thursday, and then webinars on Wednesdays, and we have one coming up with one of our carriers next Tuesday as well. So let me get to the questions here, and if anyone needs to go, I think I'm right at a half hour, and that's what I said at the start. So you have to go, I understand, but let me get to the questions here.